Hi everyone, it's Evan here from the Trade Risk on March 3rd, Friday, here with a weekend market recap video. We are first going to cover the current market environment, move into some of the other major markets, and then finish off the video looking at individual sectors, maybe a couple of individual names at the very end of this video. I hope you guys had a great week trading, and I want to remind you, if you do like these videos, you can subscribe to our YouTube channel by clicking the subscribe button in the bottom right hand corner. Simply keeps you up to date with all of the latest videos that we put out here. So let's get into markets. S&P 500, the SPY ETF, finished. Let's look at a weekly chart first. We finished up 71 basis points on the week. That's 0.71%. And the interesting, or the slightly new development here, is this is the first week in 5 weeks now that we didn't close at the very highs of the week. Typically we've been rallying right into the close here on Friday, finishing strong and continuing that trend. Notice we finally have a bit of a pull off here off of those highs. Not going to make anything, a big deal out of it by itself, but it's just notable and sort of normal to see that we're in a market that occasionally won't close at the very highs every single week. We know that we're still at very stretched levels. If we throw the MACD on there, we know we're at very, very high levels, or RSI, or any of those oscillators that you want to look at from a relative basis going back the past couple of years. So tremendous strength on the weekly chart. Just wanted to point that out. A little bit of an uptick on volume. On the daily chart, Wednesday was the notable session, and we had our midweek video on Wednesday, so we did discuss this day. Could it be a blow off top? Could this be the end of this high momentum phase? That's some of what we tried to answer there on Wednesday. And of course, no one including myself would ever be able to know definitively what's going to happen in the future, but we look for little pieces of evidence to try and structure our trade decisions. The one thing we talked about was for reference points, using this candle low, so Wednesday's low here at 238.37, that would be a good reference point. And if we came back and immediately broke below it and moved into this gap, that would be your first sign that we are a little bit too frothy, that this move was a little bit too euphoric. And we almost did that precisely, because Thursday we came all the way back down, reversed the intraday session here on Wednesday, and just closed right at that gap. Now we did probe into that just a little bit here on Friday, but you can see it was overall a flat session, and bulls stepped in and they prevented a complete gap fill. So we have signs that we are, near term, very frothy here. This gap and this session has proved to be the top so far, and we have came back down and quickly rejected these higher prices. Now, again, with this small session, this small range day here on Friday, we're going to need to see how this continues on Monday. Do we get immediate upside follow through and a retest of those highs, or can we get this gap fill? The notable piece here, beyond just this price action, is you're starting to get a little bit of breadth divergence to the downside, negative breadth divergence. Now, again, it all depends on your time frame. If you're someone that's a position trader holding stocks for a month or longer at a time, this is pretty much irrelevant to you because it's on such a minute time scale. But if you're a day swing trader trying to capture 3 to 5 days looking at next week's action, it might present a little bit of opportunity for you. So we have seen some breadth divergence in here, and that could lead to an increased probability that we do come in here and try and fill the gap, maybe come back into this old range. That's if we get the price action confirmation. So if we can break Friday's lows, you have that little breadth divergence kind of working with you. There's some evidence there that could suggest that the short side here, along with this immediate rejection of Wednesday's range, that we could start to pull in just a little bit here as momentum perhaps wane. If you want to look at an hourly chart, you could take a look at this trend line here. And again, I don't usually go this into the weeds here. I like to stick on the daily time frame. But again, for you guys who are maybe a little more actionable in looking at markets on a day-to-day basis here, intraday rather, take a look at this trend line that's pretty steep, but it started here from February 2nd, and you can see that's where we found some support here late on Friday, is riding right up this trend line. And again, you could draw it a little more accurate than I did, but you see the point here. If we start to break these lows, this trend line, you could start to get a very quick gap fill, and then perhaps a little bit of an overshoot on the downside, maybe retrace 3 or 4 or 5 points in the S&P 500. That would be, or that 5 points sounds extreme at this point, but even 2 or 3 points back down to 236 to 235, maybe that's in the cards. So something to think about. Again, depends on your time frame. If you're that longer term time frame, look at the longer term moving averages, look at these bigger support levels. I'd say 235 is a pretty key area, and then you can go back to the weekly chart and look at some of these moving averages. So tremendous strength on the intermediate long term, short term, some evidence of frothy action, and maybe we warrant some type of pullback off of that, but still don't see a tremendous amount of evidence just yet beyond this Thursday immediate reversal that we saw and some of those divergences. So there are some things there. That said, we are net short now at this point. We have longs on, but we have a couple of shorts on, so probably tipped a little bit more now in the net short camp. And one of those markets that we're short is the IWM here. And again, we're not all in short. Let's look for this huge correction. It's just a quick trade, and it's something that we do still have, of course, long exposure offset against. But the IWM is something where we got shorted here on this candle here. This is Thursday's session, and basically playing just this range breakout failure here, and looking to come back down and retest this 137.50 area. We got down to 138 here on Friday. So that's a quick trade that we have on right now. And again, we've talked about IWM as being the market to pay attention to. I still believe that is the case. It's struggling to really lift here and sort of move to a spot of leadership. It's still lagging all of the other major averages on the year. And again, it's had a couple of attempts here to take out and try and run with it. This is one of them right here on Tuesday the 21st. We really had this session here too, that we could have run with it and saw some follow through. We got immediate rejection. And then of course, this was Wednesday's session when we had the big gap higher, and then it got reversed again. So we've had 3 attempts at these highs, all of them very quickly rejected. And so far though, again, depending on your camp and where you live, 137 is still holding. We're still holding above the bulk of this supply. So again, if you're a position trader on that longer term time frame, not too much to worry about here. I'm looking to play this pretty tactical, get some short exposure via the weaker market here, and again, see if that leads to anything bigger of a potential crack into this range. So that's a quick trade that we have on going into the Qs. It really looks a lot like the S&P 500 right now, the SPY ETF. It doesn't have the big open gap like the SPY does. It mostly filled the smaller gap that it had today, maybe a little bit still open, but you can see it's closer to the 8-period EMA. Things have been slowing down just a little bit here, and it very deservingly so, because it has been such a leadership monster run for the first 6 to 8 weeks of this year. So deserves to slow down just a little bit, but very similar comments apply that we talked about there in the S&P 500. I think the lows here from Friday are pretty important, or at least on a micro level, 130.34. If we start to break below Friday's lows, then take a look at the lows here from the 24th around 129.38 and the 20-period EMA, because I think that would very quickly come back into play. Maybe some would look at this as like a false breakout here above these highs, so about a 5-day consolidation, pop above it, and then fall back over. Speaking of that, I want to bring our attention back to the IWM. One more point. If I look at the weekly chart here, this is another reason why I look at this, and you got this nice kind of poke ahead. Again, same thing we talked about, just want to show you on the weekly time frame, but you got this kind of poke above prior resistance, and then you have the failure, drive all the way back down and close the week on the lows, near the lows. The only major market to close negative this week was the Russell 2000. So again, just want to point that out in the weaker time frame, bit of an uptick in volume there. So pay attention to it. Again, we're short there for a pretty tactical trade. So with that, let's get into some of the other markets. We'll start with TLT. And again, this one hasn't moved too much from when we did our video on Wednesday. You can see this trend line, and again, you can draw this a little more precise, just use as a loose guide to show you where support has roughly come in from the lows here on December, and you can see we're below it and trying to get back above it here on Friday. Close slightly higher here on Friday, but down 2.18% on the week. And if you look at the weekly chart, this looks like a fairly bearish pattern here, as you had the strong impulse leg down throughout October, November, and December, moved sideways for about 3 or 4 months, and now threatening to sort of break down from this trend line here. So TLT bears on the longer term time frame may finally be getting another leg down, and this would be a big leg down because this is a weekly time frame. So big kind of projected move there if you start to draw those projections out. So pay attention to TLT right now. I think that's an interesting spot. Of course, we have the Fed minutes or the rate hike, the rate decision coming up very shortly, so this certainly will be in play here and in effect coming up in the nearby weeks. If we look at USO, we had a little bit of a scare here on Thursday, off about 2% on the day, and very resilient bulls here on Friday recovered about half of that, 1% rally here on Friday. So impressive hold. It continues to just trek sideways in this long, drawn-out, developed range. I still think we're going to get that uptick in volume when we really do get that breakout. We saw a little slight kind of uptick, really just hitting average 50-day volume here on USO on Thursday on that 2% down move. I do think when the real move comes, we're going to see a nice uptick there. But again, we'll have to wait for that to happen. Using the lows here from 11.15 is something now I would pay very close attention to next week. If we go to UNG next, this one just trying to stabilize after its beat down that it received throughout January and February. It doesn't look a whole lot interesting to me right now, but it is trying to do the hard work right now of just moving sideways. Perhaps wants to come and fill this and let these moving averages catch up. So it's just waiting. Doesn't look too interesting to me just yet. And then finally, the metals, gold had a little bit of a sell-off here late in the week, came all the way back down, tagged this 116.30 level, which is where support was in mid-February, and you can see it's just saw a little bounce off of it under the 20 period, closed the week down 1.8%. So something to pay attention to if you've been looking to get into gold, looking for that longer consolidation. Now's the time to start paying attention to it, see how it acts, see if it can continue to hold 116. Silver, very similar, although had a bigger drop here on Thursday, down 3.67%. You can see bulls did step in right away here on Friday, got a 1% retracement back to the upside. So there does still seem to be interest here, of course, as this grinded higher for 2 months. You get a nice sudden drop, generally is going to attract people on that first drop. So see how it acts into next week. It's going to just about reclaim that 20 period. So you can put some fib retracements on here, depending on how bad and how much of a dip you want. You could start to nibble here, look for a bigger pullback, wait for more stabilization. Really is going to depend on your situation. So that's silver, that's gold. Those are some of the major markets. Let's look at some sector analysis. We'll start it off with healthcare, and you can see healthcare is one that we wrote about recently. XLV has been a monster throughout February, is one of the top performing sectors. If you look at the monthly chart, you can see trying to emerge here from a multi-year consolidation. So from bigger picture standpoint, healthcare XLV looks great. You can see just a strong leader again this week, up 1.36%. If we go to XLU, catching its breath just a little bit, letting these fast-moving averages catch up to it. So this one's starting to move sideways just a little bit. Staples, very similar situation, starting to let those fast-moving averages catch up. Those are really the strongest sectors right now. XLU, XLP, XLV, all defensive. If we look at financials, for example, you could see bearish engulfing bar here on Thursday, got into the gap a little bit, saved itself on Friday, but still looking perhaps a little vulnerable, just that it could fill this gap. Still obviously a tremendous amount of strength from a longer term time frame. Energy as well, this one here, we talked about as a potential mean reversion play. This was down 10% off of these highs, or 9% and change, I think. We did get a nice pop Wednesday into some bearishly aligned moving averages, 8 and 20. Generally not going to be your best bet, trying to play momentum or continued upside into this bearishly aligned moving averages. So you're starting to see a little bit of a give back here, mostly in line with the market, but some of the names underneath the hood here in energy look fairly interesting. So again, I think this is still a point you could pay attention to, a sector you could pay attention to. A little bit of an uptick in volume here recently as well. And those are really the strongest. I mean, XLB or non defensive remain the strongest. XLE you could see as potential rotation. XLB you could see the materials giving back a little bit here. Cyclicals as well. So there's a little bit of kind of, I don't want to call it sloppiness, but a little two-way trading, a little sideways action sort of developing, creeping in here as you start to look at some of these other more some of the other more cyclical areas of the market, higher beta areas, you can see starting to cool off just a little bit. So I think we're going to end up leaving it there. We've already run on pretty good time. So I hope you guys enjoyed the video. Thank you again for watching, and I hope you have a great rest of the weekend.